What's up, everybody? Today we're going to go over what is presently happening in our housing market given the current administration's recent firings and policies, take a look at real data concerning inventory and home prices, and finally take a look at the DC housing market and see what is really happening here in my hometown. We got a lot to cover, so let's dive right in. As we know, real estate is very localized, so please keep in mind that what's happening in one part of the country can be very different than what's happening where you live. That being said, let's start by looking at some national data concerning the housing market as we begin the spring season, which is traditionally the most busy. According to Redfin's latest housing market update, there are more buyers out there looking at homes as mortgage rates have started to decline. Google searches of homes for sale are up 10% year over year to their highest level since July. And Redfin's Home Buyer Demand Index, a seasonally adjusted measure of home tours and other buyer-related services, hit its highest level since the beginning of the year. That being said, this is not translated into more home sales. In fact, pending home sales fell 6.1% year over year during the 4 weeks ending March 8th, on par with declines over the past few months. Mortgage rates are coming down because the country's economic outlook is getting stormier as investors worry about things like tariffs and a slightly weaker than expected job market, said Redfin economic research lead Chen Zhao. Lower mortgage rates have brought some house hunters who are waiting for costs to come down off the sidelines, but they haven't yet led to more sales because prospective buyers are still figuring out whether lower payments are enough to justify a home purchase in today's uncertain economy. Many Americans are concerned about things like job security and a potential recession. I can tell you firsthand that I've had several clients put the brakes on both selling a home and buying a home because they're anxious about their job security, especially if they're federal contractors or workers. Even those who accepted the early retirement package find themselves in a black hole of uncertainty with no clear path forward. The information is just not there, and now they're cut off from their work emails, so they're just waiting around to find out what happens next. When people are scared or anxious, they tend to freeze, which is why we're seeing even more of a constricted housing market, especially when it comes to home sales and inventory. To give you some context, according to Lance Lambert of Resi Club, during the pandemic housing boom, U.S. existing home sales soared, totaling 6.1 million in 2021 alone, well above the pre-pandemic 5.3 million in 2019. Once mortgage rates spiked in 2022, existing home sales took a major hit, and all of that pull ahead was erased by August of 2023. As of January 2025, we've seen 1.8 million fewer total existing home sales in the 2020 decade than we would have had if we had maintained the pre-pandemic 2019 pace. Mohtashami goes on to say that he believes that the low existing home sales translates into pent-up demand. Buyers are out there just waiting for the right time to buy, which could explain the recent uptick in mortgage applications. The catch? They simply can't afford to buy a home right now because of the total monthly housing costs. Your principal, interest, taxes, and insurance, or PITI, are just too high. Another way to look at present existing home sales is by adjusting for current population levels of U.S. households. The U.S. now has 76.3 million more people and 33.2 million more households than it did in 1995. When analyzing U.S. existing home sales adjusted for population size, Lambert finds that U.S. existing home sales are hovering around 4-decade lows. In January of 2025, the seasonally adjusted annualized rate of U.S. existing home sales was 4.08 million. Dividing that figure by the total number of U.S. households, 132.2 million, results in 3.1%. He states that the last time U.S. existing home sales, adjusted for population, were lower was in the 1980s, when the average 30-year fixed mortgage rate peaked at 18.63% in October of 1981. So why is it important to look at all this data of existing home sales? Because it shows a clear picture that the constrained existing home sales across our country is due to the sharp deterioration of housing affordability. In fact, according to Redfin, for the 4 weeks ending March 9th, the median sale price is up 3.2%, and the median asking price is also up 6.1%. New listings are up 3.1%, and active listings are up 9.3%, the smallest increase in over a year. The metros with the biggest year-over-year median sale increase are Milwaukee, up 15.7%, Cleveland, up 13%, Anaheim, California, up 11.7%, Nassau County, New York, up 11.5%, and San Jose, California, up 10.3%. The metros with the biggest year-over-year median sale price decrease are Austin, Texas, down 3.9%, Jacksonville, Florida, down 2.6%, Tampa, Florida, down 2%, Atlanta, down 1%, and San Antonio, Texas, down 0.8%. The metros with the biggest year-over-year increase in new listings are San Jose, California, up 35.7%, Sacramento, California, up 27.3%, Oakland, California, up 25.2%, Phoenix, up 24%, and Los Angeles, up 17.7%. The metros with the biggest year-over-year decrease in new listings are Detroit, down 18.3%, Warren, Michigan, down 13.1%, Austin, Texas, down 9.9%, Fort Worth, Texas, down 7.1%, and Milwaukee, down 6.6%. What we see here is a very active Midwest, with prices rising and new listings declining. Yet, according to Redfin, even though prices are rising in the Midwest, it remains the most affordable home buying region in the country. They state that Detroit has the lowest median sale price of any major metro at $180,000. Cleveland is the second most affordable at $217,750. Bottom line, we have an affordability crisis when it comes to housing, and it's causing existing home sales to remain constrained across our country. People just can't afford to buy a house. Some of this is due to home buyers staying on the sidelines waiting for the right time to buy. You also have homeowners who would like to sell and buy something else, but they're not willing to give up their lower monthly payments and lower interest rate. 73.3% of outstanding mortgages have an interest rate below 5% for a much higher monthly payments due to a higher mortgage interest rate. And even if they were willing to make a move, many homeowners can't even qualify right now for that new mortgage at current mortgage interest rates and current home prices. Lambert states in his Resi Club newsletter that given the current state of housing affordability, he doesn't expect a quick return to the pre-pandemic 2019 levels of existing home sales, or that all the 1.8 million lost existing home sales will transact. Instead, myself and many other housing analysts anticipate a gradual recovery, possibly following a trajectory similar to the slow existing home sales rebound seen in the 1980s. As of today, we're still in more of an existing home sales trough than an actual recovery. So what's happening here in the DC area? CNBC reports that the DC housing market is showing cracks amid mass federal layoffs. Diana Olick writes that inventory gains in the region, which includes the district as well as Maryland and Virginia suburbs, began to accelerate in January and February, up 13.9% and 41% year over year, respectively. Danielle Hale, chief economist for Realtor.com, wrote in a release, the adjustment period following federal layoffs and funding cuts has likely put some Washington, D.C. home searches on hold, both for those whose jobs have been directly impacted and those who may be concerned about what lies ahead. And the data hints at these challenges. That being said, the inventory gains in the D.C. area are not all due to people putting their homes on the market. The increase in supply is a combination of new listings and slowing buyer activity. New listings were 24% higher year over year last week, contributing to the increase in for sale inventory and dropping median days on the market, Realtor.com found. New listings year to date are 11.9% above the year ago level, but still 12.8% below where they were in 2022. According to Hale. Olick acknowledges that the bump in the DC inventory is also due to newly built condominiums and townhomes coming on the market. Construction in the DC area has been very active over the past 5 years. The share of new construction listings is tilted much more towards condos than it was 5 years ago. While DC has the largest share of federal workers in the country, other highly federally employed markets could see similar shifts in the coming weeks or months, said Hale. While I expect many households will choose to stay in the area and pivot to find new job opportunities, some will likely choose to leave and retire or find a job elsewhere. Lisa Sturdivant, the chief economist for Bright MLS, believes that interest rates have come down over the past 2 months, generally because of the economic uncertainty brought about by Trump's administration's policies. These lower mortgage rates could also be an antidote to the potential housing impact related to the administration's federal workforce layoffs, particularly in the Washington, D.C. area region. She continues by saying that there is scant evidence that federal workforce cuts have had a big impact on the region's housing market so far. However, federal workers make up about 14% of the D.C. area's workforce, and thousands more private sector workers have jobs tied to federal spending. There has been an uptick in new listing activity in many parts of the region, though it is still too early to tell whether that activity reflects seasonal trends or sometime more. I can tell you by working in the DC housing market, representing both buyers and sellers, that people are a bit freaked out. It's the uncertainty of what the current administration is doing and how it's going to be played out in real time. Like I said earlier, when people are anxious and they don't know what the future holds, they tend to freeze. This could clearly cause a restriction in inventory, especially in the most popular areas where people want to buy. With constricted inventory, the good houses that do come on the market, and by good houses, I mean those that show well and are priced right, they will sell in multiple offers and with much higher prices. Those houses that come on that are overpriced or don't show well, they will sit on the market until they reduce their price until a buyer sees the value. It is a mixed market with a serious affordability problem that the current administration only exacerbates with these unpredictable new rules and firings. The best way to navigate this housing market is to keep your head down, focus on what you want to accomplish, whether it's buying or selling, and stay true to the end goal. But you need to be in this housing market with someone who knows all the on-market and off-market properties. If you are a seller and you're ready to sell, but you're afraid you missed the market, I have the same advice. Align yourself with someone that will keep you focused on your goals and help you achieve them. I've been working as a realtor for 22 years. Yes, I am that old. We will get through this, just like we got through the pandemic and other adverse situations that were thrown at us. I just feel bad for those federal workers and contractors and anyone else who's affected by these abrupt policy changes and budget cuts. It just seems really unfair and insensitive to those families who have done nothing wrong, and now they don't understand what's going to happen in their future. We will keep covering the housing market across the country and what's happening here in the DC area every Wednesday night on my live stream, 6 p.m. Eastern Standard Time. So please join us if you want to be part of the conversation. Thanks for watching. I do appreciate it. Bye.